Welcome. This is a lecture covering the financial crisis of 2007 and 2008, where we're going to talk about what happened, what led up to it, like what caused it, and what some of the responses were, some of the policy responses, namely the monetary policy responses. I didn't get too far into the fiscal stuff. Um, if you've been paying attention to my course, I'm pretty sure you can understand why I don't get into the fiscal policy stuff here. Um, Now, when I first wrote and gave this lecture, it was in the first class I was teaching in 2017. And most of my students were like, the youngest one would have been like, 10, I think, when the financial crisis happened, maybe like, 9, 10, something like that. I don't know. And then as I was putting this together for today, I realized that many of you might have been like 3 when this was going on. So, um, I decided to try to make it a little bit more in depth to explain what was happening a little bit better because, a 10-year-old might have had some idea that things weren't right. Unless you're like this really smart, precocious 3-year-old, I doubt you had any idea what was going on. And, you can't be blamed for that. You were like 3. So what happened? Well, it was the absolute worst economic downturn that we had experienced since the Great Depression. And, you've read about the Great Depression. Things were like awful with that. Real GDP declined by about 4.5%. Prices fell by I think like 1 or 2%. The unemployment rate spiked at almost 10%, and the S&P 500 index lost more than half of its value over the course of the recession that followed, which is known as the Great Recession. Things sucked, basically. Now, when you're thinking about this, right, when you're even trying to remember maybe what you've been taught in the past, do you ever wonder, like, maybe this just feels a little too dense? If you saw that movie like The Big Short, are you thinking maybe, okay, well, that movie was pretty cool. They did sort of explain what was happening, but maybe they didn't explain it all that well, and it still kind of required you to have some sort of financial knowledge behind what was going on. Maybe there was just so much of it that was just like all this shit being thrown at you, and you're like, I don't even know what the hell's going on anymore. Maybe it got too technical. Well, you're not alone. I was, I think, 20 or 21 when this thing happened, and I didn't really know much of what was going on. And then when I got into my graduate studies, even then, I still didn't really know all that well until, a little bit later. So you're not alone if you feel that way. Don't feel bad. And, maybe all that you thought was it was just clowns like this behind the financial crisis. Like, oh, we're going to cook the books and do lots of math and we're going to get our quants and we're going to make a lot of money and we're going to use, like, I don't know, corporate buzzwords like pain points and pushback and I don't know, whatever all that awful crap is. And then we're going to make a bunch of money and we're going to swindle people. Not quite. Not really what happened. There's a lot more to it than that. And we're going to be talking about what there was to it. We're going to be talking about what led up to the financial crisis, what the economic conditions were that led into it. We're going to talk about how it affected the economy in ways that nobody thought it would, because there were policymakers that saw this coming. There were people in positions of authority that saw this coming that really thought, okay, maybe things weren't going to be as bad as they really were because they didn't know how deep the tendrils or how systemic the situation was. They didn't know that the problems, or honestly, we could say the rot, had worked its way so deeply into the U.S. economy. So a lot of them did see it coming. They just didn't think it was going to be that bad. And then there were other policymakers that thought, okay, well, there's something we could maybe try to do here, but the tools that they had really weren't all that great and probably wouldn't have done much, if anything, to stop this, and might have actually made things worse before they made anything even remotely close to better. And then we're going to talk about what policymakers did to try to rectify the situation after the financial crisis, after the collapse of a lot of these major financial institutions. And then we're going to talk about what the effects of these policy interventions were, what namely the monetary policy interventions were. And then we're going to talk a little bit about what was done in the long term to prevent this from happening again and whether it worked. So what got us into the mess? Well, maybe we've all heard things like mortgage-backed securities, collateralized debt obligations, credit default swaps, and other financial instruments that, just sound like fancy financial buzzwords until you kind of find out what they are. But that's not it. It's not like it was just those things that got us here. There were a lot of people that did very, very bad things to try to take advantage of the situation. There were very predatory private actors, and there were a lot of clueless and potentially criminally negligent public sector actors as well. But who was the worst of it? Well, you guessed it. Rian Johnson, director of the worst Star Wars movie ever made. Screw that guy. Now, to quote Einstein, everything should be as simple as possible, if not simpler. Maybe I misquoted him on that. I don't know. The guy's been misquoted so much, he's probably rolling over in his grave constantly. So, I mean, at least he's getting exercise, right? But it boils down to risk. Okay, maybe not that risk. It boils down to risky lending and borrowing, which was really screwed up by lax regulation. There was extreme difficulty in trying to be able to rate the creditworthiness of some of these risky assets, and that kind of all boiled down to this moral hazard and adverse selection problem. And everything else really stems from the moral hazard and adverse selection. Nobody was totally innocent, right? There isn't like, any party or even really any side, whether it's private or public, that was like totally innocent and, oh, well, poor us, we didn't see this coming. No, a lot of people saw this coming, and if you didn't see it coming, you really had your head in the dirt. Now, there were some people that were totally guilty, guys like Bernie Madoff. But to get into it, right, we're going to take a different approach to understanding this, right? We're going to think about it like a movie. So I've been talking all semester. It's like, we're making a movie, right? We need our interesting, our well-motivated characters. That's the principle of optimization. And then we need the engaging plot with like good conflict and a good resolution at the end. That would be the principle of equilibrium. Then we need movie critics to tell us if the movie's worth watching, who of course aren't being paid off by Disney to give Star Wars movies a good review. And that would be the principle of empirical analysis. So what characters do we have in the story? We've got households, or like consumers. We've got banks and financial institutions. We've got the federal government. We have Fannie Mae and Freddie Mac, Federal Reserve Bank, and we have ratings agencies. So what was going on? Well, with the households and financial institutions, people wanted to borrow necessary funds for a house, because rarely do you have people with enough money on hand to just go, you know what, I'm going to go buy a house today. So what they do is they choose to finance it. And the commercial bank will lend the money to them, and that loan is called a mortgage. This is where investment banks would swoop in. They would buy these mortgages up in large quantities from the commercial banks, bundle them into a security, hence the name mortgage-backed security. And these were like extremely popular because they were considered low risk. Housing prices were rising, and it meant higher returns for investors. Now, commercial banks knew this, and they wanted to lend out more, because once they made that loan, somebody else would come in and buy that mortgage from them, right? The investment bank would jump in and say, oh, hey, cool, you made a new loan. I'll buy that from you. Here's more money for you to make another loan. So the commercial bank didn't have to bear the risk anymore. And that rise in popularity in these mortgage-backed securities led to an issue of moral hazard, because the commercial banks that were issuing these mortgages out didn't have to bear the risk of default, right? Moral hazard is when there is a hidden action, right? There is something where it's like you have an incentive to engage in a behavior that you don't necessarily have to pay the price or the cost of. So you don't have to bear the risk of the default. What do you care? You're going to write the loan, right? Write the mortgage, lend the money to this family. They're going to buy the house, and then somebody comes in and buys that mortgage from you, and you've got more money to give to somebody else, right? You actually have more of an incentive to give riskier loans than you do not risky loans, because, well, there's a larger pool. You know what I mean. Anyways, banks were lowering their lending standards to be able to make more loans. This isn't good stuff. And a lot of banks weren't doing their homework on these households. And this is where adverse selection comes in. Adverse selection is hidden information. In this case, it's hidden information on the part of the households. So the banks wouldn't know if the household had any real risk of default because they weren't doing their due diligence. And they didn't really care if there's any default risk, because even if the household couldn't pay, well, that was somebody else's problem down the road. This is a process known as predatory lending. Maybe this guy is the one who wrote your mortgage out. Now, investment banks thought these were low risk because, well, they weren't really doing their homework either, because they were assuming somebody else had done their homework already. So if a few households defaulted, well, okay, it's not a big deal because, well, the bank would get the house, right? If you default, you lose the house, the bank forecloses. But because housing prices are still increasing, they could turn around and sell the house and recoup their short-term losses. So they might lose a little bit, but in the long run, the great scheme of things, they're not losing all that much. So the investment banks could then sell these mortgage-backed securities on the market, and when they did, they could stand to make a pretty substantial return, right? It was like high return, perceived zero risk. Now, the problem with these mortgage-backed securities is it was hard to assess which mortgages were and weren't subprime. Now, a lot of institutional investors needed to buy assets that were given a certain rating, like AAA, AA, things like that. But since the risk of default was unknown and not zero, there's a little bit of an issue there. And there was a smaller market for mortgage-backed securities as they currently existed. So investment banks needed a way to ascertain the riskiness of these mortgage-backed securities. And they had to find a way to get the ratings agencies to assess the creditworthiness of them. And this is where collateralized debt obligations come in. Now, to create a collateralized debt obligation, or CDO, an investment bank would form a new company called a special purpose entity, and they would split the mortgage-backed security into three classes, known as tranches. These tranches could then be sold on the markets to more investors. And whose great idea was this? Again, thanks, Ryan Johnson. You really know how to screw everything up. The tranches were senior, which is the lowest risk and had the lowest rate of return, mezzanine, medium risk, medium return, equity, highest risk, highest return. And these collateralized debt obligation classes could then be rated, which would mean institutional investors could buy them, which meant more customers. So how does this work? Well, assume a fraction of the mortgages defaulted. Not every tranche is paid out evenly. It goes more like the senior gets paid first. Once everyone in the senior tranche is paid, then it drizzles down to mezzanine. They get paid out second. If there's anything left over, equity gets paid, really the leftover scraps. And the interest rates earned on these assets reflected the risk. So if it's a higher risk of not getting paid out, well, there's going to be a higher interest rate to induce the investor to actually purchase that particular part or that tranche of the collateralized debt obligation. So what if the equity tranche then didn't get paid anything? Because that would have sucked, right? Is there a way that we could have insured them? The answer is yes. And if you were worried about the risk of default on that lowest tranche, you could get a credit default swap, or CDS. This was insurance on the collateralized debt obligation. It insured your risky purchase, and it was perceived to be safer this way. So you can get a super risky asset, and then you can be insured on that asset. So if you're not paid back on that asset because there are, enough defaults that would screw you over, you're insured because you have the credit default swap. That sounds foolproof, right? Well, problem is it wasn't. Because even though they thought they could run a game like this, they couldn't. So let's recap so far. People were taking out loans to buy a house. Commercial banks that lent them the funds owned the mortgage, which then was sold to an investment bank who bought a lot of these mortgages all at once, bundled them up into one giant security known as a mortgage-backed security. Because they were doing this, the commercial banks that were doing the initial lending didn't have to bear any risk, so they could use some pretty shady lending practices and immediately sell them to investment banks because, well, they're going to come in and buy it anyways. Who the F cares? These mortgage-backed securities were then split into three different classes, forming a collateralized debt obligation. And the classes of that collateralized debt obligation reflected the risk of default that was faced. If you were risk averse, well, you could get a credit default swap and have insurance on the asset in case it doesn't pay out. Does it seem sketchy? It does to me. And that's because it was sketchy. And if you're asking how is this even legal, well, there's a lot of relaxed regulation put into place by the federal government. And there were two government-sponsored enterprises, Fannie Mae and Freddie Mac, who were buying up a lot of these mortgages. And there were a lot of people that stood to substantially gain from these practices. So who can we blame? Well, you guessed it. Frank Stallone, everybody. I love that guy. So how did the federal government contribute here? Because I did say it wasn't just the private sector that was behaving badly. The federal government wasn't exactly all that great either. 1992, President George H.W. Bush signed a law that required Fannie Mae and Freddie Mac to help facilitate financing to low to moderate income households. Seems like a nice idea. The initial requirement is that 30% of all the mortgages were to be acquired by, or 30% of all these mortgages acquired by Freddie and Fannie. Fast forward a couple years, Bill Clinton wants to increase the ratios of loan portfolios to areas under the Community Reinvestment Act of 1977, which meant that Fannie and Freddie took more risk. Now, by 2000, we had new regulations to prevent risky loans from counting towards affordable housing, but that was dropped in 2004. The Federal Reserve is argued by some to have helped cause the financial crisis. So we're going sort of from the fiscal side now to the monetary side of things. The Federal Open Market Committee chairman, Alan Greenspan, who was around from 1987 to 2006, was argued to have held rates a little too low for too long. And when his successor, Ben Bernanke, came in 2006, he started raising interest rates. Now, by even Bernanke's own statements, the Federal Open Market Committee and a lot of others in the Federal Reserve actually saw this crisis coming long before it happened. And if you're like, okay, well, why didn't they do something about it? It's a pretty complicated answer. And there's really two big reasons that they didn't intervene. The first one is they didn't know how systemic the problem was. They thought it would be like a minor issue and it would really only affect the housing market because, well, it's covering like, mortgages, mortgage-backed securities, all that stuff. They thought it would really only affect that stuff. They didn't realize how much it had really metastasized within the entire U.S. economy. And they thought that if there was to be a recession, it would, be a slow but maybe steady reduction in GDP growth, from like 1.2 to 2.2%. I mean, yeah, it's pretty substantial, but compared to what it actually fell by, it wasn't all that much, I guess. So they didn't realize how deeply this thing had worked its way into the system. Okay, that's the easy one. What's the second one? Well, the second one is that the Fed only had control of one interest rate, which is the federal funds rate. And if you remember, that's the overnight lending rate between banks on excess reserves. So should the Fed have raised the funds rate, there was a question of how it would transmit to the rest of the economy, because it's not like they just go, we're going to raise rates, and then that's that. We make it harder to lend, and then, inflation comes down, and it slows economic growth. In a broad sense of the word, yeah, that's how it works. But when you really get into the nitty-gritty of it, especially as a policymaker, you need to know how it's going to transmit. There are different transmission mechanisms of monetary policy that are at work at any point in time, and they need to know which ones are working. They need to know the timing at which different markets would be hit, because if you think about it like, okay, interest rates and then inflation, if they raise interest rates, is inflation going to drop evenly across all sectors within the market? No, it's not. If that's the case, and they're raising interest rates, do you expect other interest rates to follow immediately, all like just evenly across the market? No, probably not. It'd probably hit other markets first, help crash them, and then maybe put the U.S. into a recession before the housing market even slowed, which could have made things even worse, because if the economy's chugging along and it's doing well and we've got substantial growth and then we go into a recession, okay, I mean, it still sucks we're in a recession, but it's better than like going into a recession and then the housing market collapses and then things get even worse. So basically, it's like the perfect storm is set up. Housing prices started to fall in 2007. And with any bubble, as prices start to decline, that bubble begins to burst. And then things start getting really bad. And we officially entered a recession in the fourth quarter of 2007. And it just kept getting worse and worse and worse. By March of 2008, the Treasury had bailed out Bear Stearns. July of 2008, they bailed out Fannie and Freddie. And at the same time, the Secretary of the Treasury, Hank Paulson, had declined any additional federal government bailouts, as he didn't think it would get as bad as it did. Fast forward to September 15th, 2008, Lehman Brothers collapses. This starts the global crisis. Merrill Lynch ends up getting sold off to Bank of America. AIG's in the hole, goes to the Federal Reserve for help. The Fed buys AIG. And then the Fed then took another $52 billion in mortgage-backed securities, but it didn't help. The Fed also cut interest rates, and, well, they unfortunately cut their federal funds rate down to 0. And you can see during the Great Recession, starting in, well, a little bit before 2008, they're cutting interest rates, and then around the end of 2008, well, we're stuck at 0. And when the nominal interest rate, which is, in this case, the federal funds rate, is stuck at 0, and that's the Fed's main policy tool, they got a problem because they can't cut it any below 0. We are now in what is known as a liquidity trap, where traditional or conventional monetary policy is no longer effective. So as interest rates approach their lower bound, it's known as the 0 lower bound in the United States because, well, it's the stated policy of the Federal Reserve. We're not going to have negative interest rates. So the lowest they can go is 0. Now, when they're at 0, the Fed's hands are basically tied when it comes to traditional monetary policy. Now, at this point, Ben Bernanke, who is Fed chair, and Hank Paulson, who is Secretary of the Treasury, went to Congress to try to get them to approve a $700 billion plan to buy out or to buy a lot of these mortgage-backed securities that were at risk of default, but Congress rejected the bailout bill. Washington Mutual goes under not long after. Stock markets start to plummet. The Dow Jones goes down about 700 points, and the S&P 500 index lost about half of its value. Basically, this sums up what happened. Perfectly, almost. This too, where everybody that engineered this is running away going, oh, now you done it, and you really screwed up. So the Treasury eventually did bail out a lot of these financial institutions. Now, according to Hank Paulson, Ben Bernanke, and then Tim Geithner, who came in later, the results would have been catastrophic if the Treasury did nothing. The Federal Reserve, headed by Ben Bernanke, also stepped in, and of course, according to Ben Bernanke, things would have been catastrophic if the Federal Reserve didn't do anything. Now, we would like to analyze the results of these policy responses from both fiscal and the monetary authorities. And really, in the interest of trying to keep this lecture somewhat short, there's just not enough time. So I'm just going to look at the monetary policy response instead. Plus, I think it's a little bit cooler in how it worked. I am a monetary economist. Naturally, I'm going to think it's cooler, but I think there's a little bit more finesse, a little bit more artistic, and a little bit more of an artistic endeavor in how the monetary policy response was engineered and then carried out. So we're going to use some of the tools that modern macro economists use to see how these monetary policy responses operated in the economy. Now, with so few options, the Fed had to do something, and they had to do something drastic, and they had to do it now. This is where quantitative easing comes in. I've mentioned this throughout the course. You've probably heard that term before, quantitative easing. Here's what happens. Typically, they buy short-term debt, and that affects the federal funds rate. But instead of doing that, what they did is they bought $4.2 trillion in long-term Treasury and mortgage-backed securities. They typically would just buy Treasuries. This time, they start buying Treasuries and mortgage-backed securities. And this was called quantitative easing, and the goals were pretty simple: to try to give enough liquidity to these financial institutions that needed it without actually affecting the money supply. So to prevent that, they paid interest on excess reserves to then incentivize banks to hold on to those reserves. And whose legitimately awesome idea was this? Well, it was actually Ben Bernanke. So we're not going to blame Ryan Johnson or Frank Stallone for anything anymore. This is actually where some kudos need to be given out, because Ben Bernanke actually studied banking crises while he was in graduate school at, I believe it was MIT or Harvard. It was one of the two. He went to like a really awesome school, studied some really interesting stuff. He studied banking crises and the collapse of the banking sector in the Great Depression, and a lot of his research after the fact had been what would happen if central banks were bound at the zero lower bound for nominal short-term interest rates. So he came in actually having a pretty decent idea of what needed to be done to actually wrap up, or not wrap up, what needed to be done to prevent things from getting worse. So this is where quantitative easing comes in. 3 rounds of quantitative easing between late 2008, early 2009, and about the end of 2014. Over those 3 rounds, they bought over $4 trillion of Treasury and mortgage-backed securities via the creation of excess reserve. So what they did is, because these assets were already out on the market, right? And these assets already had a positive monetary value. So the Federal Reserve goes, okay, these assets have value. So whoever's holding these assets aren't insolvent. They have no solvency problems. They just have liquidity problems. So what we're going to do is we're going to take these assets and we're going to convert them into cash. So they print excess reserves and then they buy these assets with the excess reserves. So all they're doing is just converting an asset that already has a cash value into its direct cash value without having to do any kind of like rapid sale where they're like, okay, well, I've got all these assets. I need to turn around and dump them like ASAP. So I'm going to sell them at like half price. You don't have to worry about that because the Federal Reserve buys them at like their market value. So it really prevented a lot of these financial institutions from going under. And when the financial institutions are propped up and they don't go under, well, mom and pop shops don't go under either. And everything really just kind of continues, hopefully, as it did prior to the financial crisis. So let's get into this reserves thing, right? Because I said, okay, well, they want to increase these reserves, but they don't want to increase the money supply. If you remember from our lecture on money a couple of weeks ago, the money base is currency plus reserves, which isn't the same as the money supply. So the Fed wants to increase the money base without touching the money supply. And it gives them the best of both worlds because these financial institutions get the liquidity that they need without any real impact on the inflation rate. But how do they do this? Well, like I said, they paid interest on excess reserves, which then encouraged banks to want to hold on to those excess reserves rather than lend them out. Because if you're guaranteed, like, okay, hold this money and we're going to give you a little bit of a return for holding on to them. You go, all right, so I don't have to lend it out and face any risk of default? No, there's no risk because, well, you're the one holding it, and then the Fed's just paying you to hold on to it. So the banks got what they needed. They didn't go under, and we didn't really get a whole lot of inflation. Inflation was generally pretty low in the post-financial crisis era, really up until COVID. And then after COVID, things got kind of ugly, but we'll be talking about that next time, not this time. So the question is, did quantitative easing work? And this is really almost the entirety of my doctoral dissertation. Did quantitative easing work? In all likelihood, yes, but we need to test it. So we run a statistical model, and I impose assumptions that are consistent with a monetary policy shock of this time period. And the idea is that if the real-world data can match the theory, then we know the theory's pretty good, and then in all likelihood, the policy worked. So we want to look at the dynamic responses to quantitative easing by using these variables. I've got the log of real GDP, log of the core PCE price index, the log of the money base, the 10-year treasury yield, the log of real wages, and the log of hours worked. Now, for all the variables, with the exception of the 10-year treasury, I've got them in logarithmic form, natural logarithmic form, because there are really some nice statistical properties that come from that. But we then get to look at how all of these variables respond over time when there's a monetary policy shock. Now, quick little aside. A lot of people that watch these videos aren't students. I'd like to think most of the people watching these videos are students because I'm seeing the view count, and I hope to God a vast majority of them are students. But there are some people that are not students in my classes that still watch this. For those of you, thanks. That's actually really awesome. Like, comment, subscribe. I do want to talk about some of the empirical stuff. So if you're in my class, just don't worry about this for like a minute. Those of you that are in the class, well, the VAR I run with 2 lags, the majority vote of the AIC HQ and BIC information criterion. The VAR itself is identified with sign and zero restrictions. I use Uhlig's rejection algorithm. R's got a really nice package. It's called varsign R. That I augmented a couple years ago with some zero restrictions. And what I do is I require that the money base, real GDP, and prices increase, and then the 10-year Treasury yield decreases. And under varsign R, the restrictions can hold for, however long as you'd like them to. Here they hold for 6 months, and then I've got these zero impact restrictions on GDP and prices to make it like a surprise. All the data come from the Federal Reserve Economic Database, or the FRED. That R code, you can actually get it on GitHub, the varsign R package. I don't know if they've got zero restrictions added in by now. Maybe they do, maybe they don't. But yes, so if any of you are curious about that, this is what I did, and that's how I did it. So, okay, now for my class, let's get back into things. Before we get started, quick recap. If there's a monetary policy shock, there's an increase in a monetary aggregate. In this case, it's the money base. The policy rate would then decrease because the cost of lending falls. It triggers an increase in desired expenditures, and we get an aggregate demand shock. Now, if prices aren't fully flexible, meaning the short-run aggregate supply curve isn't vertical, then output has to respond by some amount. And because output increases, we then see an increase in labor hours and real wages. And the idea is that this tends to hold for the short run, but in the long run, not so much because of monetary neutrality. So if we look at the LM curve, right, the LM curve shifts out when the money supply increases. So this is the first movement of the LM curve. Remember, there's actually a second movement where it kind of goes sort of in between these two here somewhere, depending on how flexible prices are. But we drop the policy rate, and then we move down to the next graph with the aggregate demand, aggregate supply. Aggregate demand shifts out, and then we settle on a short-term or short-run equilibrium point between aggregate demand and short-run aggregate supply at a higher level of output and a higher price level. Now, if we want to see what that looks like in the 5-graph system, this is what we have, where we actually have that third movement of the LM curve, or sorry, the second movement, not the third LM curve, but the second movement of the LM curve, where the price level increases, the interest rate jumps up a little bit, and then we can see, okay, there's a labor demand shock, labor increases, and wages increase. So this is the set of like the static responses to a monetary policy shock. This is what we should expect to see, right? So we look at the impulse response functions. Let's see what we got. Well, we can see real GDP increases. How do we see that it increases? Well, because remember, at this point right here, t equals 0, because this axis is time. So at t equals 0, the impact occurs, and then right after, real GDP increases, and its maximum response is a little over 1%. And then GDP kind of falls back down, and after a little while, it converges back to essentially where it was, because this lower Bayesian credibility band then crosses 0, so they're on either side of 0, and we can't really say one way or the other whether it's actually still positive or negative, because it's not statistically significantly different from 0, in so many words. So we do see a significant response in real GDP. Core PCE prices, what do? Well, they also increase, by, well, at a maximum, a little under 1%. This is, of course, the cause of the shock, the money base increases. So, of course, we'd kind of expect it to increase. By construction, the 10-year Treasury yield also falls. However, just like with real GDP and core PCE prices, they stay either above or below zero for the respective variables longer than the restrictions were held in place, which generally tells us, okay, yeah, this, the set of impulse responses kind of makes sense. Real wages and hours worked also increase significantly, although real wages increase by like a little under 1% and then drops down pretty quickly. Hours worked stays positive for a good bit longer, about 10 months or so, before it crosses over and then is essentially indistinguishable from zero. So looking at this, right, we can see there's an increase in the monetary aggregate, their policy rate, which in this case is the 10-year Treasury yield, because they were buying longer-term government debt and mortgage-backed securities. So you can sort of think of it as like a switch from the federal funds rate over to the 10-year Treasury yield. That falls, and then we get that increase in real GDP. We have an increase in prices, real wages, and hours worked, just like what we see here. So even though this is a little bit more of a rudimentary approach to things, looking at like a new Keynesian-esque model, it still gives us some pretty valuable information, because it's not all that different from what we see here. It's just this is static, this is dynamic. So we can actually say that quantitative easing probably worked. We can see inflation increased, which of course reduced threats of deflation, because remember, at this time, prices were falling. So they actually wanted to get prices to go back up a little bit because, well, we've talked about the issues with persistently low inflation. We also have an increase in output, and long-term bond yields fell. So really, in terms of what the Federal Reserve was hoping to achieve, they kind of did with this. And it very well might be the case quantitative easing could have saved the U.S. economy. Of course, we won't know without some kind of a counterfactual analysis. There's always, the fancy statistical counterfactuals that we can try to construct. But generally speaking, that's not the same thing as a true counterfactual. We don't know what would have happened in the absence of a policy intervention because there wasn't one. And of course, this worked through changes in the long-term interest rate rather than the short-term interest rate, which is what the typical new Keynesian model would suggest. But that's because the Fed's stated policy rate changed. So overall, this is pretty consistent with what the new Keynesian model would tell us happens. Now, it also worked through other transmission mechanisms or other channels of monetary policy, but that's for another time. If you're really interested, you can always go read my dissertation, I guess. The first chapter in it covers one of the major channels of monetary policy that it operated through. But we're not going to be talking about that in this video. Now, we all thought things were getting better, right? GDP was recovering. It was kind of a slow recovery, but there was still a recovery nonetheless. Then COVID hit and totally screwed everything up. But while things were getting so bad that we might have ended up in even another Great Depression, the Federal Reserve steps in to save the day. And if only we'd had Ben Bernanke in 2020 rather than Chair Jerome Powell, things probably would have been a lot better. I really wish Ben Bernanke was back. So what came after all of this? Well, we had a lot of new regulations that tried to keep this from ever happening again. One of them, this is, of course, not an exhaustive list, hardly exhaustive at all, the Dodd-Frank Act. And this did a lot of things. It consolidated some regulatory agencies. There was like comprehensive regulation of financial markets, trying to bring more like increased transparency to some of these assets. And there's, of course, stress testing. That's the big one that we're going to talk about. Banks have to show the Federal Reserve every year that they can handle certain adverse scenarios. And by these adverse scenarios, essentially what happens is the Federal Reserve will be constructing or designing some of these scenarios, going like, all right, well, if we end up in a recession, GDP falls by X amount, what happens? If we end up in like a persistently rising inflation type scenario, what happens? And they sort of construct a time path based on their expectations for the evolution of certain variables. And then they want to see how the bank's models would work, because the banks are using what's known as a conditional forecasting model. So it's like multiple equation, multiple variable model, and they'll put a condition in for one of these forecasts, namely the scenario that was designed by the regulators, and then they want to see how the bank expects to be able to weather the storm. If the bank can weather the storm, then, well, they're in good shape, and if not, well, they've got problems. For the big banks, this is known as Comprehensive Capital Analysis Review, or CCAR. And the Fed gives them these scenarios, and they've got to feed them through their models. And these scenarios are essentially the worst case scenarios that reflect what regulators think the economy is going to be at the highest risk of facing that year. And it's done every year around Valentine's Day, which I guess doesn't matter because I guess maybe they think quants don't have girlfriends or something like that. I have actually been around for CCAR once or twice. I know I was at least there once. And it's a very, very, very busy weekend. As soon as those scenarios get released by the Fed, it's basically crunch time for everybody. And, you're probably working, 30 hours or so over the course of a weekend. It was fun. It was an absolute blast. But at the end, you run all the models with these scenarios, and you can go like, all right, cool. Is the bank's balance sheet going to be okay? Will based on the assets and the liabilities of the particular bank that you're working for, will things be all right? Will the bank be able to weather the storm? And generally the answer is yes. But as a quick aside, for those of you that are like, okay, well, what happened with like Silicon Valley Bank when they went under? Because weren't there like stress testing things that were removed under the Trump administration? They didn't, have to do the stress testing anymore. Yes and no, sort of. The thing is, even with these stress tests, for the banks that were still subject to the stress tests, the stress test is only as good as policymakers are able to, I guess, see the future, because some of the scenarios that policymakers thought were going to happen in like 2022, feeding into 2023, were things like, I think it was like a housing market issue or something, which never really materialized. And instead, there was just a persistently rising inflation issue that wasn't fed through with these scenarios. So even though you can pass CCAR with flying colors, it doesn't necessarily imply that everything's going to be fine and you'll weather any storm that comes, because, well, if the policymakers don't give you the right set of adverse scenarios to try to deal with, you're not really going to get anything. It's like a garbage in, garbage out type thing. So, in conclusion, the government did take some steps to improve things. And a lot of it really was in terms of holding the private sector more accountable. They increased regulations, but, they haven't really removed guaranteed government losses. So here's the thing, right? Bank bailouts help in the short term because banks get to stay afloat and depositors get to keep their money. Everybody likes that, right? If a bank is starting to go under and you have a lot of money with that bank, you get scared. This is what leads to a bank run, and they want to prevent bank runs. So sometimes you get a lot of these bailouts. That's what the FDIC is around for, to make sure depositors aren't, if maybe not entirely made whole, they don't lose everything. But the problem is, in the long run, it adds to this moral hazard problem, because there's no incentive to behave better if you just know that you're going to get bailed out again. And the thing is, every time there's a crisis, the government enacts reforms. They try to be forward-looking, but it's really still backward-looking. And then nobody really sees the next crisis that comes. And then when there is the next crisis, we get more new regulations. But again, it's based on what's happened, not what we think may actually happen. But if we knew what actually would happen, we'd be ready for it, and the next crisis wouldn't happen. I'm sure there's probably some game theory people right now losing their minds, but whatever. So things were generally pretty okay for like 10 years after the financial crisis. There weren't any major economic downturns. There's no inflation. Well, not rampant inflation anyways. We always have inflation, but it was low. We had low interest rates, low unemployment, wage growth is pretty nice. GDP recovery was pretty slow after the crisis, but, we didn't have a recession for more than 10 years. And then COVID hit. And things got really ugly. recession, high inflation, supply chain problems, which we're going to talk about and more in the next lecture. So stay tuned. Thank you for watching this lecture, and the next one and final one for this semester is COVID. So thanks for watching.